The state or the government can't have a deficit. They can't have a surplus. They can't have a balanced budget because they're the ones that create the money. For these words to be at all meaningful, applied to the state, they have to be comparable to the deficits or surpluses or financial positions of other economic actors, like a business or an individual or a household. All these three can have a financial position. They can have incomings, the money they're receiving, their income, and outgoings. And they can have a financial position depending on what the relation is between incomings and outgoings. Are they balanced? Are incomings more than outgoings, meaning they have a surplus, they're saving? Or are outgoings more than incomings, which means they have a deficit? They have to go into debt to fund their excess spending. They have positions because these two flows are not independent of each other. What you can spend depends on what you earn. And so it makes sense to talk of budgets for households, individuals, or businesses, budgets to manage their incomings and outgoings, because there are consequences of spending, for example, more than you bring in, of having a deficit, and there's consequences of having a surplus, savings. But for the state, for the government, this isn't so, because they control the currency. They can create money in the national currency and give it out, and whether they have no incomings, for example, no tax revenue, or some tax revenue, but still less than their outgoings, is irrelevant to their ability to produce the actual money to give out. So straight away there's a fundamental difference in that at least the nominal sums of the outgoings and the incomings of the state are completely independent of each other. The state can unilaterally decide to give out, to spend a certain nominal sum of money in its currency, irrespective of how much nominal money it brings in. So straight away there's a difference. Now you could say that for nominal values this is true, but in terms of real value it's not, because a state having a deficit, like in this case, devalues its currency. Let's just imagine this scenario because it's very easy to understand. If you hold to the quantity theory of money, then the state's excess nominal spending going into the economy is simply going to cause an increase in prices. There's no new additional production in response to this monetary demand. And the nominal value of tax being taken in tax revenues is of course based on a percent, a rate of the nominal incomes of the actors buying and selling in society. So if the prices have gone up, then of course, for example, the business's incomes go up by the same rate, and the workers' incomes go up because they have to demand higher nominal sums to keep up with the increasing prices. So the income, the nominal sum of income on which the tax rate was being levied, increases, and so the same rate being levied on a larger nominal sum means that the state's nominal incomings will increase. Under the quantity theory, the devaluation of the currency, which occurs through the state creating money to give out in excess of its incomings, will automatically rebalance its budget. Because under the quantity theory, the state can't, in fact, give out real purchasing power more than it takes in. Any excess in nominal sums it gives out will just cause a devaluation of the currency to correct that nominal excess. Instead, let's imagine that the quantity theory isn't true, that The income, the real productive effort of society, is indeterminable. And to make it simple, let's imagine that this year, for which the government's doing its budget, there's a net increase in the workforce. Here we have the workforce, the labour force of the country, the number of people at working age, and there's 10,000 leaving the workforce, retiring, but there's 20,000 entering into it from school and training. So there's a net 10,000 increase. And we can pretend that because of some malfunction of the private sector, of the banking system, not providing the funds necessary to employ these net additional 10,000 people, the state steps in and has a deficit, has an excess of outgoings over incomings, and instead of a, let's say, 100% utilized economy, instead of this increase, nominal increase hitting up against 100% fully used economy, just causing price increases, it hits up one where there are 10,000 people needing jobs. And let's say the state knows this, and so it's spending that in a way, maybe directly employing these 10,000 people, or creating demand for businesses that are in a competitive sector, which are then going to hire those 10,000 people. Maybe the state has information over the sorts of training and skills that the people entering the workforce have based on statistics, and so it makes demand for the sort of industries that would be likely to hire those people. This additional monetary demand now, we could say, opens up a new circuit in circulation, to put things very simply. The point being that these 10,000 people have to, in an indirect sense, supply their own demand. Because of course, by hiring them, they're producing something, but they're also getting an income to buy other things of an equivalent value, minus profits. You have this chicken and egg problem of where the monetary demand comes from to employ these unemployed people, or to employ some otherwise unused capacity. Why would a business hire these people when they can't yet demand anything in the economy? They don't yet have a wage to make any demand, in response to which demand the business would want to invest to make profit and hire people. So the state, being responsible for the currency, for the national currency, could intervene to be that actor who's above the fray of microeconomic considerations, to see that there is an underutilized capacity, for example, unemployment, and inject demand into the economy. And that's what a state deficit is. It's creating additional demand in the economy. And a surplus is pulling that demand out. You could think of this in terms of an investment, meaning that these people will then pay tax in some shape or form, increase the tax base, which this rate is being levied on, by the same amount given out. And just like in the first quantity theory scenario, increase the nominal sum of the incomings as well. But now these increased nominal sums also match an increased real production in the economy. You could think of things in terms like this, in terms of the state being able to make investments which pay for themselves, pay off, but it doesn't have to be this case. Imagine that the state didn't raise any taxes. The difference in these two values, these outgoings and, in this case, no incomings, would still not devalue the currency, because at the end of the day, the value of the currency can only be in terms of real goods and services. So within a country, within an economic area, where that currency and an increase or a decrease in the monetary demand in that currency is measured against an increase or decrease in the real production going on, these two quantities, production and the monetary demand, are what work together in various ways to determine whether devaluation occurs, internal devaluation occurs in the sense of price inflation, price increases leading to inflation when that is maintained. And so if the excess spending of a state, which isn't financed by anything, the state can unilaterally create the money. It's not financed by anything, but if it causes a change, an increase in the real production, then it doesn't have to cause inflation. So the state has no financial position that it has to manage. It doesn't have to manage its outgoings and its incomings. What it has to manage, and this is a far better term than either deficit or surplus, is that it either adds net demand to the economy or takes net demand out of the economy. And it can do this, manage this in response to the real production possibilities. When there's a lot of unused capacity, it could spend money, excess money, or when there's signs of inflation, because the capacity that's there is there's too much demand for a limited capacity, and there's not much room at the moment for an increase in that capacity, then it can draw monetary demand out to moderate that inflationary potential. And of course, this makes perfect sense when you realize money isn't a claim against the state. It's not a debt that the state has to pay back. A piece of money isn't a claim against the state for some amount of gold or anything else. It's a claim against real goods and services. And this shouldn't be hard to grasp, because a state by definition is something that has power over its subjects. It has a monopoly on violence, and for example, it can create laws that other people, the population under that state, have to obey. So if it's acceptable for a state to exercise power in the creation of laws, so I as an individual maybe didn't design that law, I didn't agree to it, but it's seen as legitimate that I have to obey it and be punished maybe for not obeying it. That's the basis of a state, which is essentially the state making a promise on behalf of other people. And this is the fundamental point. A debt normally is a promise against yourself. You go into debt, you loan money with a promise to pay it back. A state can make promises on behalf of other people because it has a monopoly on violence. And so the state creates money which isn't a debt against itself. It's not a promise of the state. It's a promise of the population made on their behalf by the state. And so the state has no financial position. It has no outgoings. It's promises when it creates money that it has to manage in relation to its incomings, its ability to pay those promises. It's got nothing to do with that. Its outgoings are promises on the productive capacity of society. And so what it has to manage is its relative net of outgoings or incomings. So the state has a responsibility to manage aggregate demand, to ensure that all the resources are being used, to ensure that all the people who want work have the possibility to get that work. It has nothing to do with relative prices. The people being unemployed, for example, has nothing to do with them demanding too high wages, because ultimately they demand their own labor, their own employment. But because of this chicken and the egg problem, there has to be some initiator who can start this new, let's say it, circuit within the already existing circulation of goods and services started happening. And so an excess of spending over incomings of a state loses any economic significance. It's not a deficit and it's not a surplus. These have no economic meaning in this sense. You could have a moral problem with it because, for example, in this case, we just assumed that for some reason the private banking system wasn't existing, because in a dynamic real economy, potential income is indeterminate. So what usually would happen if you have a functioning banking system, for example, there's lots of businesses that are making investments because they predict future profits. So even without this clear understanding of the situation, there's going to be new businesses constantly creating demand for the capacity. and, for example, for new workers. And that demand is going to be self-fulfilling. It's going to employ the people that are then going to demand the products, increased production of that investment, for example. And so you could have a moral problem with this. You could say it's not the role of the state to intervene like this and decide in the first place where the demand's going to go, decide where the first spending is going to go. This is for the private sector to do based on profit motives. Fine, that's another discussion. But that becomes a moral argument about equivalent of laws, for example, whether one law is justified or not, whether it's acceptable that the state has made this law that allows it, that forces people to do this instead of this. It has nothing to do with economics, nothing to do with having to balance budget positions to avoid some sort of devaluation. This is all completely detached from reality.